candles are one of the widely used instruments reflecting midday and intraday price changes. They show indecision or an upcoming market shift in the existing trend. On this channel, I always advocate for mastery of price action if you want to become and remain a profitable forex trader. And there's no way that you can achieve that goal if you don't know how to read your chart, which is full of candlesticks. So on today's video, we are discussing DODY candlesticks and their important significance. But what is a DODY candle? A DODY is a candlestick that forms when the opening of the price and the closing of the price are entirely equal or very close to equal. A DODY is considered a neutral pattern suggesting indecision between the buyers and the sellers in the markets. A DODY can be either bearish or bullish. Its character depends on the type of DODY and where it emerges. If a DODY appears on an uptrend, it may signal a bearish momentum. So the location of its formation is very important. If it forms on a support or a resistance, that is very important. If it forms when the market is approaching the support or the resistance, that should tell you that the market is losing its momentum to continue pushing towards the upside direction, meaning that we may go back down because the market doesn't have enough strength to keep pushing up. A DODY can also form on a monthly time frame, signaling a very indecisive month. That was a very bad month to trade because the market was indecisive about the direction. So many traders experienced losses during this month. DODYs are commonly found on most time frames, including the daily and the weekly time frame, as well as on the 15 minutes, 5 minutes, and 1 minute time frames. Now let's get into the common types of DODYs and their meaning. We have a green DODY. A green DODY tells us that we had a strong fight between the bulls and bears, which is the buyers and the sellers. The buyers came into the market and took the market all the way up. The sellers said, no, we are not having that. They pushed the markets all the way down. But the buyers came in stronger and had enough force to continue to push the markets all the way up. But the closing and the opening of the price is slightly different. However, the closing price was higher than the opening price. And that's how we closed the day with the green DODY, representing the winning of the buyers. So whenever you see a green DODY in your charts, just remember that there was a strong fight between the buyers and the sellers. But the most important thing is the closing price was slightly higher than the opening price. And that is how this green DODY was formed. Now, with that understanding, there are a couple of things that a green DODY candlestick tells you. Firstly, it tells you about the market's indecision, meaning that the market is uncertain of where it's going right now, so there is a balance between the buyers and the sellers. Secondly, it tells you about the potential reversal. It literally says, watch out, the market is losing its momentum to keep pushing and it might pivot or reverse direction. Thirdly, it tells you about the potential breakout. If the market is already in an upside direction, is in an uptrend, the green DODY may indicate that we are about to break out. Remember about the formation of this candlestick. So when the closing of the price was slightly higher than the opening of the price, that should count for something, Yana, right? Next up, we have a red DODY. The red DODY is actually the opposite of the green DODY. It simply tells us that in this case, the closing price was slightly lower than the opening price. and the bears won this fight. However, this candlestick still represents the indecision in the market, and it entails that the buyers and the sellers are currently in equilibrium with neither side gaining overall control, even though the bears won since the closing price was slightly lower than the opening price. So in this case, it doesn't matter whether the candlestick ended up with a green color or with a red color, as the opening and the closing price of these doji candlesticks is little to non-existent. The body of each of these candlesticks are too thin to make any significant difference during the analysis, signaling no direction. And then we have neutral dojis, which are doji candlesticks with no actual body. These candlesticks tell us that the opening and the closing price are equal. The price opened here and the price closed here. The bulls or the bears didn't bother to go up, or there was no fight. These candlesticks just seated right there and said, we are just unbothered. We are not entertaining these fights. Just leave us alone. We are not moving. We are not going anywhere. And no one will be fighting. And we don't do that here. The two shadows are very widespread, signifying a high price point and the low price point. Next up, we have a long-legged doji. A long-legged doji is used to identify potential market trend reversals, especially after an extended up or down trend. This doji candlestick pattern comprises long upper and lower shadows. The open and the closing of the candle falls appropriately close to each other. This represents uncertainty about the upcoming price movements. In the long-legged doji, the supply and demand seem to equalize each other. Next up, we have a dragonfly doji. The dragonfly doji indicates a potential reversal to the upside or the downside, depending on the previous price movement. In a dragonfly doji, the opening and the closing of the price coincide very close to each other, while the low price is far away from them. The dragonfly doji is considered the opposite of the gravestone doji, and it stands for bullish dominance. A horizontal line of a dragonfly doji is what makes it different from all other dojis, since it is placed at the very top of the vertical line. Next up, we have a gravestone doji. A gravestone doji appears in an uptrend, showing market rejection for the higher price. A gravestone doji pattern has its open, close, and low price falling very close to one another, and the high price falls further away from the rest. The long upper shadow stands for buyers who held a very strong position on a fight during a day, only to lose their fight on the sellers towards the end of the day as the price is pushed down. Next up, we have a doji star. A doji star is a three-pattern bar that can be either bullish or bearish, signaling a possible market reversal. Then we have a four-price doji. A four-price doji is a doji pattern in which the open, high, low, and close prices are all equal. A four-price doji represents an indecision as the price shows no change. When analyzing and trading candlesticks, the time frame and the location of the candlesticks is very important. The meaning of the candlestick can change depending on a time frame. Doji candlesticks can be very challenging to interpret or even take trades just by using them only. I personally wouldn't encourage you to trade doji candles using just them only. You know that I am a confluence girl, so I would encourage you to use them in conjunction with other technical analysis signals that you find during your analysis to create confluences to combine with these candlestick patterns to minimize false signals. If you want more candlestick videos, comment it down below. And also go to my description box so that you can get all other videos that I have recommended for you to utilize along with this doji candle information that you got here on this video, so that you can be able to create your own confluences and become a better trader. May the peace of God rule in your heart. I'll see you on the next video.